Ever wonder how Warren Buffett, one of the world's wealthiest investors, makes his billions in the stock market? Well, we're about to embark on a fascinating journey to unlock the secrets behind his investment success. This isn't just about the money, it's about the principles, strategies, and mindset that have shaped his investment philosophy. Over the next 10 minutes, we'll explore Buffett's key investment principles, his unique stock selection strategy, and the psychology behind his decision-making process. From investing in businesses he understands, seeking reasonably priced stocks, to holding on to them with patience, we'll delve deep into the mind of this investment guru. We'll also take a look at how he uses his stock selection strategy to identify companies with stable earnings and long-term growth potential. So buckle up as we navigate the world of investments through the lens of Warren Buffett. Stay tuned as we delve into the mind of this investment guru and uncover the secrets of his success. Warren Buffett isn't a billionaire by chance. He follows a set of investment principles that guide his decisions. First and foremost, Buffett invests in businesses he understands. He's not one to jump on the bandwagon of the latest tech craze or trend. Instead, he sticks to industries and companies he's familiar with. It's this focus on comprehension that has led him to make investments in companies like Coca-Cola and American Express, businesses with straightforward models that have been around for a long time. By understanding the business, Buffett can assess its long-term value and potential, which brings us to his second principle: seeking reasonably priced stocks. Buffett is a value investor. He's not interested in overhyped stocks with inflated prices. Instead, he looks for companies that are undervalued, ones that the market has overlooked for one reason or another. He sees these as opportunities to buy stocks at a discount, essentially getting more bang for his buck. But finding an undervalued company is just the first step. Once Buffett invests in a company, he's in it for the long haul, which leads us to his third principle: holding patiently. Buffett doesn't invest with the intention of making a quick buck. He's not a day trader. Instead, he's a buy-and-hold investor. He believes in the companies he invests in, and is willing to wait for the market to recognize their true value. This patience has often paid off handsomely. For instance, Buffett first bought shares in Coca-Cola in the late 80s and has held on to them ever since, reaping substantial rewards. It's important to note that these principles aren't just applicable to billionaires like Buffett. They're foundational strategies that can guide any investor's decisions. Understanding what you're investing in, seeking out undervalued stocks, and having the patience to wait for your investment to pay off can help you navigate the often unpredictable world of investing. Buffett's approach may seem simple, maybe even too simple, but remember, simplicity is not the same as ease. It requires discipline to stick to what you know, to resist the allure of overhyped stocks, and to have the patience to wait for your investments to pay off. As we delve deeper into Buffett's investment strategy, remember that it's not about mimicking his every move. It's about understanding his principles and how they can inform your own investment decisions. After all, successful investing isn't just about following a formula. It's about finding a strategy that works for you. These principles aren't just for the billionaires. They're foundational strategies that can guide any investor's decisions. Buffett's ability to pick winning stocks isn't magic, it's method. It's a method rooted in the principle of value investing, a concept that revolves around buying securities that appear underpriced by some form of fundamental analysis. Now let's break down his stock selection process. Buffett looks for companies with steady profits and long-term growth potential. He's not interested in the latest trends or flashy startups. Instead, he's after solid businesses that have stood the test of time and have consistently demonstrated their ability to generate profits. How does he identify such businesses? Well, he uses a set of criteria to evaluate a company's worth. First, he looks for companies that he understands. This means businesses with simple, straightforward operations and a clear value proposition. He's not one to invest in something he doesn't fully grasp. Next, he looks at the company's historical performance. He's interested in companies that have shown consistent earnings growth over the past 10 years. He also takes into account the company's debt levels. Too much debt can be a red flag, indicating financial instability. Then there's the company's competitive advantage, or as Buffett likes to call it, its moat. A moat is something that protects the company from competition, like a strong brand, patented technology, or high barriers to entry. Lastly, he considers the company's management. He prefers companies led by managers who are not only talented but also have integrity. He believes that good management is crucial to a company's long-term success. By following this method, Buffett is able to identify companies that are undervalued by the market, but have solid fundamentals and the potential for long-term growth. It's a strategy that requires patience and discipline, but, as Buffett's track record shows, it can yield significant returns. In essence, Buffett's stock selection strategy is a meticulous process that prioritizes value and long-term potential. It's not about chasing quick profits or jumping on the latest trends. It's about finding companies that, over time, will steadily increase in value. In investment, mindset matters, and Buffett's mindset is a key ingredient of his success. When we dive into the depths of Buffett's investment psychology, we unravel a unique blend of characteristics that have contributed to his monumental success. These include a high tolerance for risk, an extraordinary level of patience, and unshakable confidence in his investment decisions. Firstly, Buffett's risk tolerance is not about reckless gambling, but a well-calculated acceptance of uncertainty. He understands that risk is an inherent part of investing, but unlike many, he doesn't shy away from it. Instead, he embraces it, using thorough analysis to ensure the odds are in his favor. This approach has led him to invest in companies that others deemed risky, resulting in substantial returns when these companies flourished. Next, we find patience, a trait that Buffett often emphasizes. He is not a man in a hurry. Instead, he waits for the perfect opportunity, the perfect price, and the perfect time to invest. He understands that the stock market is not a get-rich-quick scheme, but a platform for long-term wealth creation. This patience has allowed him to hold on to investments for decades, reaping the benefits of compound interest. Lastly, confidence is an integral part of Buffett's investment psychology. He is not swayed by market trends or popular opinion. His investment decisions are based on his own research and understanding of the company. This unwavering confidence in his ability to analyze and predict a company's performance has been instrumental in his success. Buffett's handling of volatile markets is a testament to his investment psychology. In times of market turbulence, when panic selling is the norm, Buffett remains calm and collected. He views these periods as opportunities to buy valuable stocks at a discount, rather than a time to sell. In conclusion, Buffett's investment psychology is a testament to the importance of patience, confidence, and a keen understanding of risk. His success is not a result of luck or chance, but a product of his mindset and approach to investing. It's a powerful reminder that in the world of investing, mindset truly matters. So, what can we learn from Warren Buffett's investment journey? We've journeyed through the guiding principles that have shaped one of the greatest investment minds of our era. From focusing on businesses we understand, to seeking out reasonably priced stocks and exercising patience, these principles are not just concepts, but practical tools that we can apply in our own investment decisions. We've also delved into the meticulous process of selecting stocks, a method that Buffett employs to identify companies with stable profits and long-term growth potential. Every company he invests in undergoes rigorous evaluation, with a focus on intrinsic value and potential for steady returns. Moreover, we've explored the psychological aspect of Buffett's investment strategy. His risk tolerance, patience, and confidence in his decisions, even in turbulent markets, are key components of his success. These traits, while seemingly intangible, can be cultivated with discipline and a deep understanding of the investment landscape. We've also uncovered the secret behind Buffett's success, the consistent application of his investment principles, and a steady mindset. These are not exclusive to the billionaire investor. With thorough research and understanding, these principles can be applied by anyone who is serious about their investment journey. The beauty of Buffett's approach lies in its simplicity and applicability. It's not about quick wins or gambling on the stock market. Rather, it's about careful analysis, patience, and a deep understanding of the businesses you're investing in. So as we wrap up, we encourage you to take a deeper look into Buffett's investment strategies. Understand them, apply them, and refine them to suit your own investment style and goals. Remember, Warren Buffett's success didn't happen overnight. It's a result of consistent application of sound principles and a steady mindset. So why not take a leaf from his book for your investment journey? Share your thoughts in the comments below, and don't forget to subscribe for more insights on investing and